Good afternoon. My name is Bradford Allen, and I am an advisor here at Secured Retirement. Thank you all for joining this week's Market Huddle. Today we will be discussing what the Inflation Reduction Act means to you, and we'll also provide an update on our outlook for inflation going forwards. Before we jump into things, we'll go over our disclaimer that the attorneys make us share. So as a reminder, all investing involves risk. This information is contained for general information only and does not constitute an offer to sell or offer to buy any security or investment. The information is not intended to be used as the sole basis for financial decisions, nor should it be construed to be individual investment advice. So let's jump into it here. So the Inflation Reduction Act, I'm sure you've all heard about it. It's the recent piece of legislation proposed and recently passed by the Democratic Party. It's called the Inflation Reduction Act. You might be asking yourself some questions. What is in it? Will it reduce inflation? And how will it impact me? A quick update on the status. This was passed by the Senate on August 7th by a vote of 51 to 50 along party lines, with the Vice President Kamala Harris casting the tie-breaking vote. It was passed by the House last Friday, August 12th, on a party line vote of 220 to 207, and it's expected to be signed by President Biden this week. So going forwards here, this bill, despite its name, is actually primarily a climate and healthcare bill. President Biden's initial bill, the Build Back Better, was a 10-year, $3.5 trillion proposal that had a much higher amount of spending and covered various items in the Democratic agenda beyond climate and healthcare, including expanding Medicare benefits and easing immigration restrictions. That bill was shot down by Senator Joe Manchin of West Virginia as being too costly. This bill is basically a watered-down version of that bill. And what is included is $369 billion of new spending, which is primarily as a reduction in greenhouse gas emissions, investments in clear energy technologies, and to extend subsidies for the Affordable Care Act. This is meant to encourage industry and consumers to shift from carbon emitting to cleaner sources of energy. And it will help 13 billion people pay premiums for privately bought health insurance. The most noteworthy, especially to families that we work with here at Secured Retirement, is that beginning in 2025, people insured by Medicare will be subject to an annual cap of $2,000 on out-of-pocket prescription drug expenses. So they are putting a cap on the amount that can be paid out of pocket on prescription drugs for those on Medicare. Also, beginning next year, Medicare beneficiaries will not have to pay more than $35 per month for insulin, which is another piece of this. Let's see here. In order to pay for this, what is being proposed is the following. It's anticipated to raise $740 billion in revenue over the next 10 years, 1/3 of which will come from government savings for lower drug prices. There's also a 15% minimum tax on corporations making over $1 billion. Also a new excise tax on share buybacks. $300 billion of revenue will come from these last two items, which is the 15% minimum tax and the buybacks. And then the other piece is there'll be stronger IRS collections, including an increase to IRS staffing. So you might be asking, are there any new taxes in this bill? And the short answer is yes, but they're taxed on corporations and not direct taxes on individuals. So to dive into this a little bit deeper, the 15% minimum tax is likely to affect individuals in the form of higher prices and lower wages. Corporations are going to pass this added expense by charging more for the goods and services that they provide, as well as paying their workers less. They won't necessarily drop wages, but future wage increases are likely to be less than what they have been historically. Also, stock prices will be lower since stock buybacks will be subject to an excise tax, likely to reduce the number of stock buybacks. Buybacks tend to push stock prices higher since they are seen as a positive sign from the company and reduce the number of shares outstanding. Many workers receive compensation in the form of stock options, so fewer buybacks are likely to lead to lower stock prices and less compensation. Also, lowered outlook for future overall stock market. So the big question is, does this reduce inflation? And according to the nonpartisan Congressional Budget Office and the independent Penn Wharton budget model from the University of Pennsylvania, there will not be an immediate impact from this legislation. And in fact, it's likely to be some upward pressure in prices over the short term, looking at 2023 and 2024. However, all estimates are very minimal and not statistically different from zero. So there's a lot of low-level confidence this legislation will have there's a very low level of confidence that this legislation will have a measurable impact on inflation. Chances are it is as likely to increase inflation as much as it will reduce inflation. In both instances, though, the effect should be minimal. Speaking of inflation, we did want to provide an update on our outlook going forwards here. Last week, the Consumer Price Index, also known as the CPI, was reported as being higher by 8.5% for the month of July compared to July of last year. This was below expectations of an increase of 8.7%, but remains elevated and still near 40-year highs. This number is also less than the 9.1% increase reported for the month of June. So it's leading to the idea that we have reached what was known as peak inflation and pricing pressures are beginning to slow down. But even if inflation has begun a downward trend, it looks to remain elevated. Our thoughts are that inflation will remain over 7% for the rest of this year, 2022. We're thinking probably in the range of 5 to 6% in 2023 and drop down to about 4% in 2024. All of these are above what we've experienced over the past couple of decades, and certainly something that needs to be taken into consideration when planning for retirement and determining your income needs. And we'll dive into that a little bit deeper shortly. So even though inflation appears to be moderating, it still remains at near 40-year highs. So the Fed still has a lot of work to do. It is expected that the Fed will raise rates by at least 50 basis points, or 0.5% at their September meeting, with further hikes in November and December. It is too soon to say what they will do in 2023. If economic conditions worsen, they might be forced to lower rates. But if the labor market remains strong and inflation remains elevated, they could continue to raise rates. This will have serious investment implications since higher rates will put pressure on economic growth and the overall stock market. And higher rates also adversely affect bond prices. So this is a good time to consider alternatives to protect your portfolio. So let us know if you would like to have a conversation to discuss options to reduce the bond exposure in your portfolio. We can go over some bond alternatives. Continuing on with inflation, and just as a reminder of how inflation affects your retirement savings, we can use the rule of 72, which is a rough calculation stating that by dividing 72 by the inflation rate, you will obtain a rough estimate on how long it takes prices to double. So if inflation is at 3%, that says, according to the rule of 72, that prices will double in 24 years. But if inflation is at 6%, prices will double in 12 years. And at 6%, they will quadruple in 24 years. For many people who retire in their mid-60s, it is very reasonable to believe that they will live 24 years or into their 90s. Does your retirement plan allow for increases to your income to keep pace with inflation? The last thing you want to do is find out at an advanced age that your income does not stretch as far as you need it to. So if you have any questions and want a second opinion on your income plan, please give us a call and we're happy to discuss that. Wrapping up here, we'll go over upcoming events. So next Monday, we will have another Market Huddle webinar. The topic for that will be back to school and how much of your money goes to taxes. Also on August 29th, we will have a lunch and learn here at the office. It will also be streamed, a live stream virtual. So please register for that if you're interested. You can also watch from home if that's easier. So that about wraps it up with the Inflation Reduction Bill. If you have any questions, feel free to add them to the chat box at this time. Otherwise, if you want to discuss further with one of the advisors on our team, you can reach us via email at info@securedretirements.com or give our office a call at 952-460-3260. We're happy to discuss further. Thank you all for joining. We will have a replay of this video posted on YouTube in the near term here, John. And thank you all for joining. We'll see you next week.